Hi, Spencer here, and today I'm going to talk about how to trade predictive price patterns. Now, if you look at a chart, you might notice that there are often recurring patterns that happen on the chart, and many of them have predictive ability because you notice that after you see these patterns, so the odds tend to favor a certain direction once the pattern is completed. This tells you that these patterns do have predictive abilities. If you look back using history as a guide, you will find that history often does not predict the future exactly, but it tends to come pretty close in terms of the cycles, and it gives you an idea of what you can possibly expect in the future. So just like trading, you notice that a lot of these charts have these recurring patterns. So some people might think that it's a self-fulfilling prophecy, right? That because people believe it and people trade on it, therefore the outcomes turn out this way. So whether that is true or not, the important thing is that if you are able to identify these patterns, you will be able to make use of their predictive abilities to affect and increase the probability of your own trades. Now, when many people look at these patterns, the way that they usually do it is they try to memorize the patterns and then they just try to identify on the chart and trade. So that actually is a very big mistake because the key thing to these patterns is actually the psychology behind the patterns. So more importantly for you to identify than identifying the patterns is for you to understand what goes on behind these patterns, and usually that is a fight between the bulls and the bears. Now, there are two main types of patterns. So in this short video, I'm not going to go through every single pattern in detail because I will actually have a separate video for each of them. So in this video, I'm just going to go through generally all the different patterns that there are, and they fall into two main types. The first are the reversal patterns, and the second are the continuation patterns. Now, the reversal patterns are patterns that tend to lead to a change in the trend, hence the word reversal, whereas a continuation pattern tends to continue the existing direction which the trend was before the pattern occurred, hence to continue the direction of the trend. So for reversal patterns, there are a couple. These are the more popular ones. Starting at the top, you have the double top. So in this case, you can see that it's a double top. So price goes up, it forms a double top, and then it reverses downwards. So there can be a triple top as well. I've just drawn a double top. And on the opposite end, we have the double and triple bottom. So in this example, I've drawn the triple bottom. You see there are three bottoms before it reverses up. Here we have the head and shoulders. So these are the two. This is the left shoulder, this is the right shoulder, and this is the head. So when there's a head and shoulder, the price reverses downwards. And this is the inverted head and shoulders. So similarly, there's a head, two shoulders, one head, and the price reverses upwards. Next, we have the expanding triangle. So you notice that this is a triangle that gets bigger and bigger. So this is a sign of confusion in the market, and usually it is found near the end of an uptrend. So hence I've colored it in red because it tends to be more of a bearish pattern, bearish reversal rather than a bullish one. The next pattern is an accumulation pattern, hence it is green. So this is usually found in an uptrend for stocks where you see an accumulation of buying and followed by so this is the cup followed by the handle before a final breakout. Next, we have the wedges. So there's a rising wedge and a falling wedge. So the name is a bit contradictory because the rising wedge is actually a bearish pattern where the prices try to go up, but they get incrementally weaker and weaker until finally they start to break down. So for the falling wedge, prices get slowly, the decline gets less and less, meaning the bulls are fighting control from the bears, and finally you see a breakup to the upside. So remember, a falling wedge is bullish while a rising wedge is bearish. Next, we move on to the continuation patterns. So we have a very neutral pattern here, the rectangle, right, which is pretty obvious. Prices move sideways within the rectangle. And you have the next we have the pennant and the flag. So these two are actually rather small patterns, which are usually found in very strong trends. So for example, when in a very strong uptrend, you see a very sharp movement up, and then the price will have sort of a small consolidation or pullback over here, right? Similarly, in the flag, right, a small consolidation or pullback followed by a resumption of the existing trend. So that is a pennant. This is a bullish pennant which breaks upwards, right? And the opposite is a bearish pennant which breaks downwards. So this is a bull flag and this is a bear flag. Next, we have the triangle series. So we have the symmetrical triangle, which is very neutral. So it's a sort of a 50-50 chance whichever way will break up. And then we have the ascending triangle. So you notice the ascending triangle, this is a flat line on top. So prices are slowly building pressure upwards with higher lows, right? And before they finally break out. So ascending triangle is a bullish pattern, whereas descending triangle, you see that the prices make consecutively lower highs before they finally break through the level over here. So that is a bearish pattern. So after knowing all these patterns, right, how are they useful in your trading? So the first most obvious use of it is that it provides you of a roadmap of the likely future movement of the prices. So for example, as the price patterns are forming, you're able to, it provides you a roadmap of how the prices are likely to unfold, right? Because prices are going to sort of, develop the pattern, right? And once the pattern is completed, how whether the odds are going to be higher or lower, whether it's going to have higher odds for it to break downwards or upwards, depending on the type of pattern, whether it is a bullish pattern or a bearish pattern. So that gives you an additional trading edge because it gives you a higher probability for your trades. So the key thing with these patterns is that you don't use it alone because you can combine it very effectively with other techniques like price action and indicators to give you the additional edge. And lastly, it is the price projection of the pattern is useful for you to get a certain profit target. So this one we will cover in our next video because every price pattern has its own unique projection, which gives rise after the pattern is completed. So that's all for this video. For more videos and market analysis, please visit us at www.synapsetrading.com, and I'll see you in the next video.